Well, time to then get to our market masters of the day. Bank of America Securities 2025 India conference has kicked off. In fact, it will kick off actually next week. The focus is going to be on growth acceleration in India. So let's discuss the view, the house view, then just ahead of that conference with Amish Shah, head of India Research, and Arbind Maheswari, head of India Equities at Bank of America Securities. Gentlemen, morning. And thank you so much for joining us in person in the studio. It's always a pleasure to speak in person. And I was going through your note, Amish, you and your team's note, 9 structural drivers for India, right? Sounds fantastic. So I think in the near term, you folks are slightly cautious, given the run-up, given the valuation. So let's just start there by understanding the top-down house view on the near term. Then we'll come to the 9 drivers.
Sure. So look, near term, we had set out a target for Nifty at 25,000 for December. I think we are right about there. So we think markets are now likely to mostly consolidate as far as Nifty is concerned. Valuations are full. Clearly, we can't fault the long-term drivers or the growth in India. Macro story continues to stay well. But 21 times at Nifty, it's almost at +1 standard deviation. So if you're a near-term investor, our advice is that maybe start booking some profits. If you're a long-term investor for a 2 or 3 year period, then the view is that you should expect muted returns going forward.
Wait, but you're saying that maybe the best is over for the calendar year, despite the fact that, look at global markets. And it's tough to call these things, but now the courts are challenging Mr. Donald Trump and markets are rejoicing it. There's so much still going on.
And Surabhi, there will be therefore some excitement to the markets in the near term. But if you would recollect, we were always pricing in that India will go through a trade deal quite soon. And there'll be benefits of China +1 on the back of that. So there has been some market rally on the back of that already. So some sectors which were going to be more impacted, like autos, maybe pharma, IT, on the worries that US economic slowdown could cut down on tech spends. There might be some rally as a relief as of now. But beyond that, India was never pricing in for a Trump tariff impact. And logically should not get, a big rally on the back of that either.
Fair enough.
Amish, just to complete the point about the way markets are going to move now in the near term. So we're in the last leg of the rally, at least for this year. 25,000 is your Nifty target. But your note also talks about 5 emerging risks that make you cautious. So tell us about that. And is there a risk of a downside from here on? Could we see some derating?
So, Reema, think of it like this, that if you were bullish markets, I'm sure you are going to talk about 5 factors, which is there is lower crude, weaker dollar, there is ongoing monetary stimulus, there is a possibility of a fiscal stimulus on the back of extra RBI dividend and excise duties on fuel, and you could possibly talk about the India-US trade deal going through, or maybe the tariffs not existing anymore. All of these put together, therefore the bullish view is that growth will accelerate.
Correct.
And we completely agree with that view. The problem is that this is only half the view, because growth will accelerate is a directional view. The moment you start to quantify it, our problem is that we think that whether you talk about capex growth, consumption growth, corporate earnings growth, credit growth, all of them will have a shallow recovery in comparison to what markets are already pricing in. Take, for example, Nifty in FY25 has delivered 5.5% earnings growth.
Okay.
We are expecting it to go up to 9 in F26, but the street was at 22, has scaled down to 14, but it's still 14, not 9.
Correct.
Same goes for capex and credit and consumption and so on and so forth. So the worry is that every result season, therefore, acts as a market correction event because earnings will keep on disappointing. So that's the first problem. The second risk that we see is that over the next 12 months, there are 6 state elections, starting with Bihar in October. And I think that will lead to a re-acceleration of populism, which is something that market never likes. Second concern. The third concern is that, yes, there is a tariff scale down, but then there is a re-appeal to that. So the point is that the global macro and geopolitical uncertainties are not gone. They will keep markets volatile, right? So when you club it all together in the context of full valuations for Nifty, maybe at almost +2 standard deviation valuations for mid and small caps, the room for error is limited. And as a result, when we are saying that the markets will consolidate, obviously it's not going to be a straight line.
Yeah.
So depending on the news flow, you will have a little bit of a volatility. And actually, we've been using that volatility to our advantage quite well. And I'm not trying to claim credit here, but because we knew that market fair value is 25. When the markets were at 26,500 back in August last year, we were negative, and we were calling for a 17% downside. When the markets actually came down to 22,000 in March of this year, we upgraded markets with the price target remaining the same as 25,000, and we played for that 15% rally. Now that the markets are at our price target of 25, we are asking investors
This range stays 22 to 25 broadly, or 26?
So 22 now, I think, will really require some big macro or a geopolitical event. There is nothing in the horizon right now. So I think a pullback as sharp is unlikely. But could there be a +5, -5 kind of a trading range? Quite possible.
All right. Hi, Amish. Hi, Arbind. Welcome to the studio, and all the best for the conference as well. So you're sounding far more, skeptical about the markets as of now, a little bit cautious at least. And kudos on that call. I recollect, when we were at lower levels, we were calling for 25,000 odd. That said, one thing that's keeping the markets afloat is this strong DI flows. But you all are calling out peak DI flows. Explain that to us. What's the rationale? I mean, because everyone talks about this financialization theme, a larger number of people contributing, but you all are calling this out. So run us through that.
So Nigel, if you look at the number of demat accounts in India, just 5 years, like January of 2020, before when the entire rally of the markets has started, or the financialization theme has started, we had about 2.7% of Indians investing in equities, right? That number is now close to 13.7%. So there is more than 5-fold increase in terms of the number of investors in equity markets. Now, I can explain this in a variety of ways, but let's say loosely speaking, you talk to any consumer discretionary company, they would tell you that 20% of India is the real market, right? So 20% of India has some discretionary income to consume something discretionary. It is only logical, therefore, to assume that if you have some discretionary money, only then will you go and invest in equity markets. Otherwise, the money that you earn is just catering for your basic needs. So if the cap is going to be at 20 and you are already at almost 14, the acceleration from 14 to 20 now is going to be slower versus an acceleration from 3 to 14. The second point to think about it is that obviously the investor who came in at 3 to 5% was richer and had more disposable income to invest in market as compared to the 14 to the 20th guy, right? So the per capita dollar that an incremental investor will now invest is also going to be lower, right? And given the valuations that we are, as we are discussing, clearly Indian retail investor is also quite smart, and that is reflecting in numbers. So if you look at markets peaked in September last year, domestic inflows peaked in October last year. Yeah. So October inflow number was $8.6 billion a month. That number since then, if you track from November, December all the way to now, has been between $4.5 to $6 billion. So markets peaked, flows peaked. Obviously, if they were to go back to 22,000, I'm sure there will be a flood of money coming in. So a retail investor will buy the dip. He will try to sell the top. And in that context, I would say that the pace of acceleration of flows that we've seen in the last 5-6 years, the pace slows and the pace now becomes more volatile versus a secular trend earlier.
That's a very interesting trend that you've noticed, absolutely. And I track those flows here. Every month the mutual fund data comes out, and you're right, 41,000 crores of inflow coming in around Diwali, and now we are down to about 25,000. So that's an interesting point. That when markets fall, people keep buying. I think that's the new normal. But Arbind, let me come to you as well. Tell us a bit more about the expectations from the conference, and more importantly, we're in an environment where there is a lot of expectation that globally investors will look away from the US. They've been very US focused all this while. Now money needs newer homes. Are you hearing that within your ecosystem? And then how is India stacking up? Because the Chinese market has the advantage of valuation on its side. Much, much better. They don't have the problems that Amish just described. So, what is the expectation from the FPI fraternity?
Sure, and thank you for having us here again. It's exciting times. There is massive interest in the conference. Last time was a super successful event, and this time it's bigger, it's better. And hopefully we'll have you at the conference as well. The number of investors is just testament to the fact that investor sentiment, despite all of this caution is still very alive and kicking. Look, some of the themes, like you mentioned about the demand for non-US dollar assets, I think it's just about starting. And it's going to remain that way for a while. It is clear President Trump wants a weaker dollar, and we are not going to fight it. So you will continue to see demand for non-US dollar assets increase. And when we look at emerging markets as an asset class, that itself becomes a very interesting play on the back of that non-US dollar demand, because you saw from, even from mid-24, the outflow numbers were massive. Now, April to date, since what is called now the Liberation Day, that when the tariff noise started, we've seen about $19 billion of inflow in emerging markets. And what we saw as outflows from the middle of 24, only 20% of money has come back so far. So I think there is still room for that to grow in terms of inflows from emerging markets. And then India being at the heart and center of now the emerging market indices, I think there will be increased amount of passive allocation anyway coming our way. And plus, whoever is looking at benchmarking against the emerging market indices, I think India becomes a very sort of safe haven. So yes, valuations are one part of the problem, but if you look at top-down macro, it's hard to find fault with India at this point. And I think that story is going to be, there's not too many large pockets of investment opportunities in the world outside of the US that will be able to absorb capital.
For the benefit of our viewers, I just want to call out the 9 themes that you've singled out in your latest report. And these are medium-term structural themes for India that Bank of America Securities likes. Rapid infrastructure build-out, productivity gains, digitization, financialization, the resilience in household savings, the shift in discretionary consumption, formalization of the economy, the current account moving from a deficit to a potential surplus, and decarbonization. So all of it tying in together to present perhaps a solid medium-term picture for India. Based on this, I mean, either of you gentlemen can take this. Which are the key highlight themes that you plan to call out in the conference? What is it that, as a house view, that you're most optimistic on? Is it renewables? Is it power? Is it what's the new sunrise sector, or even if it's an old sector, and what's the sector of the future?
So I can take that, and maybe Arbind can chime in. So see, first of all, I think Surabhi, the good news is that some of these themes have been playing out for a while, but now they are coming together. So a confluence of them coming together, I think, can have a bigger impact. So to some extent, they are all connected. So let's say, for example, India is doing a lot of capex, but how do you fund that capex? So when you have household balance sheets getting better, and then they go back to savings, that saving then in turn funnels into funding the investments. And then that once the infrastructure kicks in, then you have the productivity gains to it. The formalization of economy is equal to larger, better, bigger companies growing market share at the expense of unorganized players. Unorganized players, as we know, were leaking taxes. Organized players pay taxes. So then the government gets more money, and the government then wants to use that money into productive use. So a lot of these things, I'm just trying to say, is that it's connected. And when they come together, it's a even bigger or a powerful theme. So when I started my career, I recollect there was a perennial complaint about India running twin deficits. Like we are a current account deficit and a fiscal deficit country, and as a result, we had higher rates, higher inflation. Currency was always a problem. We don't talk about that anymore. Currency is stable. Little bit up and down, it's fine, but it's markets. But otherwise, currency is stable. Rates are quite low. The gap between U.S. Treasury and our Treasury has been the lowest ever. So all of these are macro benefits, and it just makes cost of doing business cheaper. And when the cost of capital is cheaper, obviously, there are more businesses that become viable.
But you're still saying 25,000 on the index.
Yeah, meaning if I were to put a target up until December of 25, which is in the here and now, because meaning unfortunately, as we know, markets is nothing but EPS multiplied by valuation multiple. Valuation multiple for 10% EPS growth is already at 21 times. How much more are you likely to pay? We are already at +1 standard deviation. So I think the good news is that, a lot of countries globally don't have that structural theme.
Yeah.
So at least India is a structural growth
At least
story.
we have the background, I mean, the
Yes,
backing.
Amish, for the longer term, India is good. Come on.
Absolutely.
I'm putting most of what I earn into the
Absolutely.
Indian market.
So Nigel, in fact, I would support it with a data point. We looked at India 15, 20, 30 years. You'll be surprised that after US, India is the only market globally to have delivered the best market returns in US dollar terms.
Yes.
So despite the rupee depreciation, second largest return generating market. And over a 10-year period, India is the highest number of stock compounders globally.
Wow.
Right. So clearly, there is need to find the bottom-up ideas. There will be compounders. Market will grow structurally.
Yes.
But for the near-term investor, 25,000 is the full price.
And
You asked-
also just one more point on that, because the SIP investor, I think only in the Indian markets and the United States have made a lot of money. So keeping your SIPs going, that's something that our retail audience obviously, looks for some guidance on. I personally do that as well. So keeping your SIP going, the longer duration, maybe the near term we're hitting a peak on the headline index, but longer duration, India should do well. Another quick point, since you all were talking about this rate easing cycle, a couple of sectors will do well.
Sure.
One such theme you all are pointing out is autos. Could we narrow it down a little bit? Because, the rate easing cycle will give more amount of money in the hands. You have the tax cuts as well that are coming there. So what do you like from the auto pack? Either of you all can take it.
So, and I will broaden that answer to some extent, Nigel. We are of the view that economy needs a stimulation. Unfortunately, there is not too much of room from a fiscal side to stimulate right now. Therefore, large part of the onus is on monetary.
Yeah.
Monetary, there are plenty of tools and the government will use it or the RBI will use it. So because monetary stimulus will continue, we are broadly positive on everything which is rate sensitive, domestic cyclical. So that includes financials, autos, as you mentioned, REITs, real estate, some internet. So this is all that we like. Within the auto space particularly, we are more constructive on the passenger vehicles right now, followed by two-wheelers. Given that we think that the infrastructure growth is relatively going to ease, we are not that optimistic on the commercial vehicles as of now.
Arbind, capex has been a big theme for our markets. It's, stocks have done very well. In fact, it's one of the 9 structural ideas for you, good infrastructure rollout. Yet you are underweight on capex-linked plays like industrial cement. Why is that?
So, look, ultimately what Amish also pointed out earlier, if there is elections coming up, there is more populism, generally that money goes away from capex into doing these kind of measures. And it becomes harder then for, anyway, execution challenges remain in that segment. So as much as we want the capex push to be there, you have to be able to execute the allocated outlays. And if that doesn't come through into execution, ultimately the growth challenge then becomes a bottleneck. So which is why to what Amish was mentioning about the money tracking financials and autos, rate sensitives, and we are seeing that in April to now, whatever money flow has come through from foreign investors, you can already see more than 50% has gone into financials if you track the data. So clearly the market also wants to be where the policy support is going to be.
You're also cautious on momentum plays. What would you classify as momentum plays? Would it include, say, for instance, defense, which has had a fantastic run up until now?
I'll let Amish take that.
So, Reema, the short answer is yes.
Defense is one. What else comes in momentum? And then tell us more about it.
So I would say defense, SOE pack in general, railways, industrials, power utilities. Primarily, the bigger definition of it is capex-linked stocks. So as Arbind mentioned it, if I were to just put some numbers to it, central government capex between 21 to 24 was growing at 30% CAGR, is now likely to grow at 10. State government capex was growing at 21% CAGR, is now likely to grow at 8 or 9. Right? The overall capex pie was growing at 20% CAGR, is likely to now be at 10. So there is a rapid scale down in terms of growth or the second derivative that we are talking about. On the other hand, subsidy bill of India, states and center put together was $91 billion back in FY23, FY24, in 2 years' time is expected to be $127 billion. So there's a 40% increase in a couple of years' time.
And this moderation in capex, is that a structural theme? Because it'll keep putting a lid on stocks that you're talking about.
So in terms of the growth rates, yes, given where the tax collection growth rate numbers are. Meaning, is there a stoppage to capex? Not really.
No.
But are we in the era of growing at 20+%? We are not in that phase anymore, right? So the nominal GDP will grow at 10-11. I think capex will grow at the same run rate. So if you had an economist in the room, he would argue that capex as a percentage of GDP is at least a flat line. It's not shrinking. So why are we complaining?
It's the alpha.
The capex analyst in the room will argue that the growth is down from 20 to 11, and therefore stocks needs to adjust to the valuations. Therefore,
I'm glad you brought that up, put it on the table before anybody could ask counter questions. Finally, gentlemen, where are you on the mid cap, the SMID versus large cap universe debate? Because the narrative so far this year, and it's played out, is that large caps offer a lot more value. Just stay with the big boys, and that's where the money is. So how do you see it now?
If I take a fundamental cap on, then I clearly think that SMID caps are more expensive than the large caps. There are various ways to argue it. I will just give you a couple of data points. In the last 3 years, the growth premium of small and mid caps over the large caps was 16 percentage points. 16% extra growth. Okay. So clearly that justified valuation premium. Yeah. Right? If you go into the next couple of years, that growth premium is going to shrink to 400 basis points. Okay. But the valuation premium at the peak was 50%. Right now is at 45%. So growth premium has massively shrunk. Valuation premium has hardly shrunk. So from a fundamental basis, I would say that large caps are cheaper. Mid caps are more expensive. But from a flows perspective, till the time the money continues to rotate into small and mid-cap mutual funds, as a mutual fund manager, what choice do I have but to chase the same stocks and bid them at higher valuations?
When money comes in, all bets are off. Then all arguments fail, right? You don't stand in front of a moving train.
There is a lot of supply of paper as well coming through, right? So that is, and that will, once the large caps and the big boys have raised some money and that is out, you will see a whole host of mid, small cap names also. And look, I think
I'm glad you brought that up, Arbind. Could that put a further lid on the market's excitement because there's so much of supply in blocks on a daily basis? There are IPOs coming.
Look, I think at some point it will be a cause for concern, but I think we are starting out from a very low base, right? We had a very dry Jan to April. So 4 months, literally, we had like $1.65 billion in cap raises in deals across all segments, whether it was IPOs and blocks, etc. Now, this is the first month in May where we have seen almost $5 to $6 billion. Now, if you recall, second half of last year, we had almost $7 billion every month. And ultimately, obviously, that at some point started to fatigue the secondary market. So I think it's still early to call that a reason for concern. And obviously, as the market expands, the free float expands. I think we want more companies listed. There are some great stories in India. We want them to come into the listed space and get all retail investors to be able to participate as well. So I think it's great for a great outcome structurally for the markets longer term.
Okay, all right, gentlemen. Good hearing your thoughts. And in fact, on that point, it could explain why the mutual fund industry was sitting at such elevated cash levels. I think it was around 2 lakh crore. Pure equity AUM as a percentage are around 7%, so prepared for some kind of supply. But thanks a lot for coming down. We take your thoughts on boards and wishing you all the best for the conference. Look forward to having you all post the conference as well. All the best, gentlemen.
Thank you, Nigel.
Thank you.